Hello everyone, and welcome to the Financial Profit. Today we have a very special episode for you. We're going to discuss the state of the markets, and we will continue to examine why the major stock market averages may have bottomed and why, despite the transitory volatility phase, there could be much more upside ahead. I'm also going to do a short case study about one exceptional buying opportunity, a stock that is very emblematic of the broader market here. So watch until the end. Okay, so last week we talked about the buying opportunity. We talked about buying high quality stocks as the market was likely bottoming. And today we're going to discuss the rebound, that we observed last week and we're continuing to observe today. So we're going to discuss this rebound, and believe me, there are still plenty of excellent buying opportunities in the market as we probably remain around a low point here. So it's been a challenging start to the new year by certain metrics. The S&P 500 is down by about 4% year to date. The NASDAQ and the Russell 2000 indexes are down by about 8% each year to date. Now we're seeing the rebound continues, but they're still down considerably from their recent highs. And even my tech-heavy all-weather portfolio, AWP as I call it, has dipped into negative territory for the year recently. Now, as the market remains volatile, there are increasing calls for a recession, and many market participants believe that the recent decline may be the start of a bear market or a prolonged market downturn of some sort. Nonetheless, as I reported in my previous article about the tariff tantrum and the buying opportunity, my view remains that the market is going through a transitory downturn due to the overreaction to new policies, including potential tariffs and other uncertainties that are enabling volatility to increase in the near term. So in other words, the tariff tantrum is likely creating a considerable intermediate and long-term buying opportunity here. Now, contrary to the broad pessimistic atmosphere that is observed in the markets today, the U.S. economy remains very dynamic and robust. The labor market resilient, inflation moderating, and the Fed put may be back on the table. Additionally, we could see substantial tax cuts, fiscal stimulus, deregulation, and other pro-growth initiatives announced relatively soon. Moreover, the AI market, tech, and other crucial segments of the economy appear to be functioning relatively well. Corporate profitability remains solid, and we could see better than anticipated earnings results and guidance due to the transitory increased uncertainty and the lowered estimates. So it's very possible that the recent volatility and uncertainty has caused market participants to lower their estimates moving forward, which could turn out to be very positive for markets as we exit this transitory, volatile, and uncertain phase and the estimates improve in time. Meanwhile, many crucial high valuation equities have adjusted lower, potentially setting up the environment for another move higher soon. Let's take a view technically. So technically, all eyes are on the 5,500 to 5,600 support level in the S&P 500. Now, it's important to mention that the 5,500 level is the 10% correction mark. We saw a successful test of the 56-5,500 support level on Friday. Moreover, I want to point out the positive reversals on Wednesday, Fed Day, and on Friday, triple witching, which are very significant given the recent volatile and uncertain state of the markets. So it's very bullish to see that we saw the bullish reversal on Wednesday when we had the FOMC decision and the dovish Fed comments by Fed Chair Powell. And moreover, we saw another very bullish reversal on Friday when the market on triple witching day of all days tested the key 56 to 5,500 support, successfully reversed and closed around the highs of the session, which was very bullish price action, setting up the bullish price action today on Monday, March 24th, and likely forecasting future bullish price action moving forward. Also, the SPX rebounded on massive volume on the triple witching Friday session. This dynamic is quite positive and bullish and might illustrate that the market is running out of sellers now. Also, from a technical standpoint, the S&P 500 became highly oversold recently. We saw the RSI briefly drop below 30. The CCI was below negative 100 for several weeks, which is almost unprecedented. The price action dropped considerably below the 200-day moving average, further underlying the highly oversold market conditions. So, what are we seeing here? We are seeing that the 55, 56 support level is holding up. Also, the full stochastic has crossed above the 20 level. So these are very bullish signals that suggest we may be witnessing a shift to a more favorable momentum. Generally, the technical image appears much more positive than it did several weeks ago. Despite the potential for more near-term volatility, this dynamic suggests that we could see a continued recovery with potential for making new highs relatively soon. Now, I want to talk about the Fed put being back on the table. I'm not sure if you noticed, but the Fed chair was relatively dovish when he spoke after the FOMC decision on Wednesday. Now, this is a welcome change from the Fed chair's recent posture in recent meetings. So we saw the Fed chair relatively hawkish in recent meetings, but I did sense quite a change in tone. Exactly for what reason this occurred, I'm not going to speculate, but I definitely saw a much more dovish Fed chair when he spoke last Wednesday. So the Fed wisely avoided directly commenting on potential fiscal, trade, and other policies while stressing that an uptick in inflation in future months could be transitory. So basically, the Fed chair put emphasis on the possibility for an increase in inflation due to tariffs. The Fed chair also put more emphasis on the labor market, highlighting that the Fed likely wouldn't wait for inflation to fall much further before acting on rates if the labor market were to turn more south. Possibly, most importantly in my view, the Fed will cut back on the Treasury side of its QT portfolio, decreasing the QT from 25 billion a month to only 5 billion a month. And this dynamic is crucial as, first of all, it's beneficial to the market to decrease quantitative tightening, and it is the logical move to reduce quantitative tightening. Of course, we need to reduce the level of quantitative tightening before we remove quantitative tightening, and we need to remove quantitative tightening altogether before the Fed can introduce any kind of QE in the future, which is not necessary now, but it's always good to have the door open, and potentially we could use some QE in the future, which will be very beneficial to stocks and other risk assets. And also, the elimination of quantitative tightening goes hand in hand with reducing rates more. So again, it's a very positive thing that we're going to see QT eliminated, as it opens the door to more rate cuts and potential QE in the future, which is very positive. So we now have about a 73% probability to see the next rate cut in June. However, we may see these probabilities increase even more, and we could even see a potential rate cut in May if inflation continues to moderate, or if we see more weakness in the labor market in future weeks. We're essentially seeing the shaping of the Fed put coming back, which is very bullish for risk assets. So in other words, we're basically seeing right in front of our eyes the Fed shifting to the position where it's saying that, yes, inflation is important, but it's come down a lot. So it's not that important for us to press down inflation down to the 2% target rate. It's more important to monitor the health of the labor market. So the Fed chair is emphasizing the importance of the labor market more, which is basically bringing the Fed put back. Now I want to talk about the massive fiscal shift, because I said shift because there are always two sides to the coin. There's the monetary policy, and then there's the fiscal policy. So we definitely need to talk about both here, because in my view both are equally as important. So while the Fed dynamic is very constructive, we're continuing to see that pivot towards, the Fed put being back on the table. So that's very positive, and it's highly favorable. But like I said, there are two sides to each coin, and we should consider the future of fiscal policy as well. So now the reason why I call this a massive fiscal shift is because we see the federal government attempting to move away from the wasteful and inefficient spending, status quo, and we're looking for a move toward a more fiscally responsible and pro-growth stance. Now, I'm not talking about growth from the government standpoint, growing the government economy. No, I'm talking about reducing some of the government regulation and constraining policies, and moving toward more of a pro-growth free market economy, which we actually need a smaller government for. While estimates vary, we may see about a $4 to $5 trillion worth of tax cuts, which will take effect over the next 10 years. This dynamic is very bullish for the future of the U.S. economy, as the cuts translate into higher economic activity, including better than expected economic growth, most likely, higher corporate profitability, and other favorable factors. Now, in addition to the tax cuts, we could see massive targeted trillion-dollar infrastructure spending packages. We could also see deregulation in energy, finance, and other segments boost growth in future quarters and in future years. Therefore, the future fiscal policy matches really well with the future projected monetary policy, potentially greenlighting the market for much more growth ahead. So again, to sum up, what do we have here? We have the Federal Reserve, which is looking to end QT, lower interest rates, and potentially, if needed, introduce QE in the future. Now, on the other hand of the equation, we have the fiscal policy, the fiscal stimulus that will likely include tax cuts, deregulation, fiscal spending, as well as other potential factors that will boost the economy from the fiscal side, which is really favorable, as we have both monetary and fiscal policy kind of providing really favorable tailwinds for the market as we advance. So let's discuss some of some of the crucial data ahead, because data is very important. And before discussing the future data, I want to just highlight some of the recent data, as we witnessed what I call a Goldilocks jobs number earlier this month. It's Goldilocks because 151,000 jobs was not too hot or too cold, but just right for the Fed to pay attention to the labor market, as we see Fed Chair Powell doing more now. So it makes the Fed pay attention more without illustrating too much weakness in the labor market, which is very positive. Also, recent inflation, building, housing, industrial, and even the Atlanta Fed GDP Now data was better than expected. Granted, we've seen some weakness in the soft data like inflation surveys, consumer sentiment, and other soft data points. However, I want to stress that these are mostly soft data. Soft data meaning that it's data from surveys. So the consumer sentiment and other surveys can be soft, especially during a transitional time like this. Now, this week, let's talk about the upcoming data, because this week we will see CB consumer confidence data. Also, we will see new home sales, durable goods orders, oil inventories, GDP data, and perhaps most importantly on Friday, we will see the core PCE. The core PCE, as many of you probably know, is the Fed's preferred inflation gauge, and the PCE, the core, especially the core PCE read, could increase or decrease the probabilities of a future rate cut, which is very important for risk assets and stocks in general. So I want to talk about earnings, because big banks will begin reporting earnings on April 11th, which is less than 3 weeks away. This will be a crucial earnings season, of course, as expectations have come down a little bit because of the recent transitory volatility and the fear of future tariffs and other policies, and people are even using the R word increasingly. However, the market may have overreacted recently, and I see no reason to expect a considerable earnings decline or for companies to issue poor guidance. There may be more uncertainty than is typical for the market. However, the market is constantly dealing with uncertainty. Thus, the recent volatility phase may be more of a hiccup rather than something scary and lasting earnings-wise. Another factor I want to highlight is that essentially no matter what happened, no matter what was reported, most stocks got sold off after their recent earnings. And this was likely because stocks became very overbought in the near term during the recent earnings. I'm talking about high quality market leading companies like Nvidia, Broadcom, Meta Platforms, Amazon, and many other mega cap stocks that declined around or after their earnings, despite posting better than anticipated and often excellent results. So before I get into the huge market leading companies and their valuations, I want to take a look at one company that I think it's very emblematic of the recent stock market action, especially momentum stocks. And the stock that I want to talk about in a little bit more detail here is a company called Marvell. It's a semiconductor company, a chip stock. So let's discuss this quickly. It's not just the mega caps, of course, that have gotten beat down recently. Many smaller high quality stocks got demolished during the recent panic wave. One of my favorite smaller stocks to discuss here, and it's a stock that I picked up recently, is Marvell. Now, I've watched Marvell for a long time before finally buying it because it was so overbought. Now, I also consider this stock as sort of the poster child for the recent sell-off in the market. For anyone not familiar with Marvell, it's one of the top stocks in the highly lucrative data center AI accelerator space. So these custom chips that are used by many companies in their data centers. Now, I'm not going to get into the details, but these accelerators are different than NVIDIA's and AMD's GPUs, but they're used for similar purposes. Now, let's take a look at the chart here, because this stock has been demolished recently. It's pretty amazing looking back at Marvell, as the stock became highly overbought, technically around the $100 to $125 range. Now, Marvell fell victim to the early year momentum sell-off, and its stock was already around $85, or down by 33% from its all-time highs when the company reported earnings. Despite reporting better than expected top and bottom line numbers and guiding higher than was anticipated for Q1 2026, Marvell stock dropped through the $85 support, cascading all the way down to a recent low around $65 to $70 support. Now, I initiated my position a day too early at around $73 to $74. I opened my Marvell position at. So if I was a little bit more patient, I could have gotten the stock in the $65 to $70 range, which would have been ideal in my view. Now, I think the stock has considerable upside from here. We witnessed a peak to trough haircut of about 50% in the stock. Also, Marvell trades around a forward fiscal 2027 P ratio of only 19. So I think it's important to point out that Marvell just entered its fiscal 2026. So this is how the company does its accounting. So fiscal 2027 is its forward year. It's its next year. So we can calculate its forward P by fiscal 2027 earnings per share estimates. And this stock trades at a forward P of only now 19, which is ridiculous. During its low around $65, the forward PE ratio on Marvell crashed to only about 17, which is ludicrous. Again, I just want to use Marvell as a proxy for the broader market here, because for AI growth market here, because some of these numbers are just mind-boggling in my view. So again, we should note that despite the transitory decline, Marvell remains a high-quality growth stock. Now, this is per consensus estimate. I'm not using any higher end estimate, just consensus. Marvell should increase sales by about 42% this year, and roughly 21% next year, in fiscal 2027. And after that, Marvell could keep this high growth rate, 20%. It could keep this high growth rate going for several years in the future, primarily because of its market-leading accelerator chips that are in very, very high demand. And there are many markets that use these chips. And it doesn't seem likely that the growth rate will slow down considerably anytime soon, in my view, which is why I like the stock so much here. There has not been any confirmed indication that the AI growth will decrease substantially, especially to the point that Marvell's aggressive repricing suggests. Now get this, Marvell's EPS growth is anticipated to be about 31% next year. Now, given its forward P ratio of only about 19, Marvell's PEG, price to earnings growth ratio, is only around 0.6 here. So while not all stocks may be as favorably priced as Marvell here, there are many opportunities in the market, as we've seen a broader theme of dropping stock prices, evaporating AI premiums, and decreasing valuations, especially in the high-quality AI tech space. So let's look at the MAG valuations, because now I just call these the MAG stocks. There are eight companies out there that are around the $1 trillion level. We can just use these 8 companies, and I just simply call them the MAGs. So number 1, Alphabet, traded down to a forward P of a 16 price to earnings ratio recently, which is just ludicrously cheap. And it's trading at a PEG ratio of around 1.1 here, which is, for Alphabet, for Google, it's very cheap. Unless there's a real recession coming, this stock is a screaming buy here. Amazon, forward PE 25, and for Amazon, a 25 forward PE is remarkably cheap, because we know that Amazon can crank up its profitability anytime the company likes, and it has the amazing AWS business. A forward P of a 25 is very cheap for Amazon, and a PEG ratio, a forward PEG of a 1.25 is remarkably cheap for Amazon. Tesla, we know it's a special situation stock. P ratio 70, still high. PEG ratio 2, relatively low for Tesla in my view. So I think Tesla is a buy here. Broadcom, PE ratio down to 24, PEG 1.2, very cheap for Broadcom. Meta Platforms, forward P ratio recently down to below 20, PEG ratio now only 1.33. Now moving down to these final 2 stocks, Microsoft and Apple. These stocks, I believe, are still a little bit overvalued. 26 forward P and a PEG ratio around 2 is not too high, but still, in my view, these 2 stocks can trade sideways or even drop a little bit lower, but they're not really that expensive here anymore. So valuations look much better. Valuations on the MAG stocks and other stocks are much more attractive. So we're looking at a 15 to a 25 P ratio for these giant market-leading companies like Alphabet, Amazon, Nvidia, Broadcom, and others. And this appears cheap. Even more so, the PEG ratios that are around or even below 1 look extremely attractive, as these tech giants' valuations are now discounted considerably relative to their future earnings growth potential. Again, excluding Tesla, given its special, quote, special situation stock status, the only two stocks that still appear relatively costly here are Apple and Microsoft. The other MAG stocks appear cheap enough to accumulate, especially if you have an intermediate and longer term horizon. The S&P 500 recently declined to only about 20 times forward earnings per share estimates. The NASDAQ 100 is cheap around its 25 forward PE ratio. We should also consider the heavy MAG weighting, especially in the higher valuation Apple and Microsoft stocks. These two stocks account for about 13% of the S&P 500 weights and roughly 17% of the NASDAQ 100's weight. Therefore, the valuation on the average stock in the S&P 500 and the NASDAQ 100 is even cheaper than it seems. The forward P ratio of 24 for the Russell 2000 is also very cheap. So I believe that small cap stock with increased exposure to the US domestic market are a strong buy here, especially going into April's tariff announcements. There's no credible data that implies that there is a 50% plus probability for a recession in the next 6 to 12 months. We may have, quote, a shock negative Q1 GDP print, but unless a crisis of confidence occurs, we're not likely to see 2 negative quarters of GDP. Therefore, despite the recent volatility, I remain bullish on high quality stocks and the market in general here. And my S&P 500 price target range remains 6,800 to 7,000 for year-end 2025. I want to thank you all for watching my profit report. I really hope that you enjoyed it. I would also love to hear your comments. So please join the conversation in the comment section below. If you like watching my video, please click like. You can also click share and please subscribe to my channel because I really like making these videos for you guys. The more people that are subscribed to my channel, the more it makes me want to create these videos. And I really think that they're beneficial to people. Otherwise, I would not be creating them. You can also join the Financial Profit, my investment community, which is Seeking Alpha's #1 service for proven portfolio profits. We have more than 500 group members, and our amazing investment community keeps growing due to our consistent and very solid portfolio returns. Thank you very much for watching my video. I really hope that you benefited from watching it, and see you next time. Have an amazing day.